Okay, so what if I told you that the absolute biggest AI investing opportunity out there right now probably isn't the famous companies that literally everyone is talking about? Welcome to this explainer. I am so pumped you're here today because we are going to completely shift how you look at the market.
I mean, for the last few years, we've all watched AI stocks go on this absolutely incredible run. We are talking trillions of dollars, with a T in market value created by absolute titans. Companies like NVIDIA, Palantir, Broadcom, AMD, and Microsoft. To put that into perspective for you, that is wealth generation rivaling the GDP of major nations. And it happened in just a few short years. It's been staggering to witness, right? You've seen the headlines, you've seen the charts just going straight up and to the right.
But lately, something has fundamentally changed. If you've been watching the markets at all, you've definitely noticed that a lot of these powerhouse AI stocks have kind of stopped climbing. Actually, some are seeing really sharp corrections. And it's got everyone asking this exact question. Is the AI boom over, or is this just the next stage of one of the biggest technology revolutions in history? Well, today, we're going to separate the hype from the reality.
So here's our roadmap for today. We're going to start with the generative AI boom, then look at exactly why stocks are falling. After that, we'll cover the vital.com lesson, introduce the new investing playbook, explore the broader AI ecosystem, and finally, figure out how to actually survive the hype cycle.
All right, let's dive right into Section 1, the generative AI boom.
Now, this boom didn't just happen overnight. It really kicked off the second generative AI captured the world's attention, which basically sent businesses and governments into a total panic to adopt it. We saw hundreds of billions of dollars pour into three key areas: AI chips, data centers, and cloud computing. And why those three? Well, because training an AI model takes a mind-boggling amount of computing power. You need thousands of highly specialized chips running in tandem, and that requires massive, super resource-heavy infrastructure. Suddenly, literally every single business on Earth wanted to brand themselves as an AI company. And investors? They rewarded anything connected to it. Chip makers soared, software companies surged, and cloud providers hit record highs. It turned into one of the strongest tech rallies we've seen in decades.
Which brings us to Section 2. Why are stocks falling?
Okay, so here is a fundamental disconnect that a lot of newer investors just don't realize. Great companies do not always make great investments at every single price point. When excitement gets this extreme, stock prices can launch like a rocket, rising way, way faster than the actual earnings of the business. But eventually, grounded investors wake up and ask, wait a second, can these companies actually earn enough real money to justify these sky-high valuations? And when the answer is no, or even just not right now, well, that's when you get a sharp correction.
So the absolutely crucial point here is understanding the reality behind this market weakness. Look, companies are burning massive amounts of capital building out AI infrastructure, interest rates are still relatively high, and everyday investors are simply taking their profits off the table after seeing huge gains. But that last point, unbeatable market expectations, that is probably the biggest one. Think of it like a student getting a 98% on a test, but their parents are furious because they expected 110%. That is basically Wall Street right now. A company can report genuinely excellent earnings, but the stock still falls just because the hype demanded the impossible.
Let's look at some history in Section 3, the dot-com lesson.
So take a trip back to the year 2000 with me. Internet stocks spectacularly crashed. A lot of those early dot-com companies, the ones with nothing more than a dot-com in their name and maybe a sock puppet mascot, they completely disappeared. But did the internet disappear? Absolutely not. And we saw the exact same thing happen with smartphones around 2007 and cloud computing in the 2010s. The core technology survived and totally thrived. Just think about Amazon for a second. Its stock got absolutely hammered in the dot-com crash, but the company survived to become a global titan. Artificial intelligence is incredibly likely to follow this exact same path. The wild, frothy excitement might cool down, but actual AI adoption, that's going to keep growing for a long, long time.
So, we need to completely shift our mindset here. The question you should be asking isn't, is AI over? No way. The much better, way more profitable question is this: which AI companies will still be leading 10 years from now?
That leads us perfectly into Section 4, the new investing playbook. Instead of just blindly buying up every single company that slaps the letters AI onto its PowerPoint presentation, we need a logical framework. So, here's your step-by-step checklist. First up, look for real revenue. Is this AI actually generating money, or is management just talking about it on an earnings call to get a quick stock bump?
Second, watch free cash flow. Third, identify durable competitive advantages. Do they own valuable AI chips, crucial cloud infrastructure, unique data, or maybe really strong customer relationships? And fourth, watch valuations, because like we just talked about, a wonderful company can become a terrible investment if you just pay way too much for it.
I actually want to drill down into step 2 for a second, because it's absolutely vital. Free cash flow. Basically, this is the cash a company generates after accounting for the enormous amounts of money they're burning just to support their operations and infrastructure. And why does this matter so much? Well, because right now, some of these fast-growing AI companies look amazing on paper, but behind the scenes, they are burning piles of cash to keep that growth going. If they aren't retaining actual cash, they are incredibly vulnerable.
Moving on to Section 5, the broader AI ecosystem.
I want you to think about the 1849 gold rush for a second. The people who made the most reliable money weren't the folks digging for gold. They were the ones selling the picks, the shovels, and the blue jeans. It is the exact same here. The AI ecosystem is way larger than just the big-name chip makers. You have to consider the infrastructure required to make all this work. We're talking massive data centers, the incredibly demanding power grids and specialized cooling systems needed to run them, cybersecurity to protect all that data, and even robotics. These foundational picks and shovels companies could continue to quietly benefit massively, even if the general retail enthusiasm cools down. Honestly, you could even look at diversified AI ETFs to help reduce company-specific risk while still riding this massive wave.
And there is this massive evolution happening right now. On one hand, we've got the traditional AI sellers, right? The hardware and cloud providers. But on the other side, there is a massive, often overlooked opportunity. Businesses using AI rather than simply selling it. Think about healthcare, fintech, industrial automation. These traditional sectors are quietly utilizing AI to drastically improve their services and cut their costs. And what that means is they could become some of the absolute biggest, most under-the-radar AI winners over the next decade.
Which brings us to our final section, Section 6, Surviving the Hype Cycle. Look, the biggest mistake you can make right now isn't buying AI. The biggest mistake is chasing the hype. Buying in after massive rallies, completely ignoring valuations, or stubbornly believing that every single ticker symbol that mentions AI is going to magically become the next NVIDIA. Doing that is pretty much a guaranteed recipe for disaster in your portfolio. So, the absolute most crucial point I want you to take away from this explainer is this. The best investments often happen when excitement disappears. The easy money from that first initial wave? Yep, it's probably already been made. But the AI revolution itself is incredibly early. Markets reward patience. The companies that create lasting value won't necessarily be the ones making the flashy headlines today. Your goal is to find businesses with strong fundamentals, real cash flow, and durable advantages. Because the biggest winners often aren't the most popular today. They're the ones still leading when the hype is long gone. Which leaves us with this final, massive thought. Do you think the next trillion-dollar AI company has already been discovered? Or is it still flying completely under Wall Street's radar? Let me know what you think in the comments below, because I would love to read your takes on this. As always, remember this explainer is just for educational purposes and is definitely not financial advice. Always do your own research before you invest. Thank you so much for learning with me today, and I will see you in the next one.